We're still focusing on pots, buckets and bridges. And if you hadn't noticed, I'm 60 years old and I have 6 million rand.
Which you're clearly not happy about.
But I don't think it's enough. I'm wondering.
Eleni would like us to redo the study with 100 million. She's asked to potentially increase it. She says you can't live off 25 grand.
Anyway, let's continue the conversation. Henry, you were discussing whether these numbers were realistic and where to from here.
So firstly, this is an average number. Yeah, we can unpack it much more in terms of probabilities. It's a bit of a different point, but they do support the averages over time. So I'm happy that what we're looking at in terms of the curve here is about as realistic as we are going to get it. Yeah, the second point that I was making, and this speaks to a question Ronan was asking earlier on. So if I am going to build a bridge, if I am going to have capital in place for the first 2 years or so, before I start drawing my income off my central strategy, my core strategy, does it really matter what my money is in? Whether it be in cash or whether it be in a guaranteed or protected strategy.
It depends on what your expectations are, and obviously the end investor doesn't know what the markets are going to do, and most of us probably don't know either. But if the market were to run very hard initially, and markets can go up 40% in a year, and you miss those first 2 years, you could be a lot wealthier, whereas if you had your money in cash in your bridge, you're not going to benefit from any initial move in the market. So at the end of 2009, if you put it into a capital guarantee, you wouldn't have lost any money if the market went down, but you would have benefited from the massive run-up. So it's all about timing there, but at least you got that sort of peace of mind that if the market does run, you're actually going to get wealthier.
Yes. Let's look at Eleni's example and try and illustrate this practically. Okay, so Eleni, you're drawing a 5% income, you've got 6 million rand, so it's 25 grand a month. That would suggest that if you
are taking inflation into consideration, because I'm starting to worry quite a bit.
Your inflation?
When I'm 60.
let's assume this is a real term discussion, and I'll graciously say, well, yes.
Okay.
So okay. Let's say that we do. What that implies is you're going to need roughly in your 2-year bridge, what's that? Sort of 600,000 rand. Okay, that's 25,000 rand a month over 24 months. Okay, so you've got 600K in your little bridge here. If the markets go through an exceptionally strong period, let's say on average we get, Roland, give me a number. 40% a year for over 2 years. No, Roland, give me a realistic number.
25 is probably a strong year.
25%. That means on my 600K I'm going to make, 90,000 rand a year? Is that,
so can I go spend that money or do I have to reinvest it?
Well, different question. Okay, so if the markets do something, if I were invested in the markets, then I would have lost out on about, is it right, 90,000 rand? Okay, I would have lost out on about 90,000 rand. The question is, if I had invested this in the market and carried it forward over the next 30 years of my life, would it have been worth much more? Yes, it would have made a difference. However, that's a great argument if you're not drawing any of the capital.
Correct.
Okay, now what I need to remember is I'm taking 25,000 rand a month out of my pool of 600,000 rand. Hopefully I could get my dirty fingers on the money. But anyway, so if the market is going to run, there will be strong months and there will be bad months. Yeah. So the odds are, as I start drawing my income, by the time that there's a spike, it's sort of a 25% spike, and that concentrates on 4 months of the year, I'll have much less than 600,000 anyway, especially if that happens in year 2. So the bottom line is this. If you're going to start drawing down on that capital base, the opportunity cost of otherwise having invested that money directly in that market becomes much smaller.
And also, if the market is down significantly like we saw in 2008, should you naturally just start drawing down less on a monthly basis and decrease your standard of living?
You see, that is a very interesting question, because what happens often is that people look at this 5% drawdown or the 25,000 rand per month and they live to the hilt in order to kind of keep to that living expense. And then when times become tough, they can't necessarily pull back on that. What you should really be doing is you should be saying in the kind of the tough times, how much, is there less I could live off? And potentially in the good times, is there fat that I could potentially utilize in my portfolio, hence excess return that I could potentially bank and then compound out? Now, if you're doing that kind of thing, then that potentially works a lot better than, for instance, using structured products or trying to use derivatives in order to try and keep the markets kind of within a certain band, so to speak, for your first 2 years. You see, Eleni, what we use.
These are pre-tax numbers that we're looking at. This 25,000 rand.
Eleni, what we did for Eleni's examples as well is that we assumed that she was going to invest for if she was going to go into a bucket strategy, we suggested that she uses a kind of a more of a moderate portfolio. Now let's look at what happens if you use a balanced portfolio, because remember now you're kind of upping the risk here, Lenny. So we're going from a moderate portfolio where you've got about 40 to 50% in equities, and you're going up to a balanced portfolio where you've got about 50 to 60% in equities. So for all intended purposes, the pot, just to bring you back into the discussion here, the capital is invested in a moderate portfolio. That's about 40 to 50% in equities. A bridge, first couple of years is in cash, and then the rest is in the moderate portfolio. And you can see what the line looks like there. And there you can see, Eleni, you continue to run out at age 100. Now let's look, if you use the bridging strategy, or sorry, if you use the bucket strategy,
I like this one.
and
very
you now take your long-term capital and you put it into something balanced. That means you've more got like 50 to 60% in equities. Look what happens to your capital now. Eleni, are you planning to live forever?
Beautiful. I love that. It's beautiful.
Well,
curve.
you're probably going to live beyond. You're probably going to be okay as
And
far
then it
as
comes
your
back
as
to the
far as
question
your
that Roland mentioned
as
with
far as your
regards to how
total is
much I want
concerned.
to leave behind for my grandchildren.
Yeah, but, absolutely. Now all of a
And your
sudden
children.
those kind of questions become available. If you look at your screen, you'll see if we put those lines together, there you can see pots and bridges. Basically, this exactly the same answer. And if you were going to go the bucket route, the bucket route, ensure that you at least take your long-term capital, which should be the majority of your capital, and you ensure that that is invested in an aggressive fashion.
Do clients, when you give them these options, do people go for the obvious, the bucket option?
They start crying.
I'm worried. I want
Once-
more than 6 million rand, I'll be honest with you, when I retire.
Once they stop crying, there are a couple of things that they also need to consider before they choose which one of these strategies they will be looking at. Because realistically, if you've got a reasonable amount of money, and I'm going to retire today, and I'm going to speak to 3 or 5 different advisors, I'll probably have a recommendation around each one of those strategies, and I'll have to choose which one is going to make the most sense. Buckets do better when. Okay, so let's try and summarize this. When your income drawdown is fairly low, because that means that the largest percentage of your assets are in growth geared assets. They do well when the growth geared pool, so your big long-term bucket, is invested very aggressively. As opposed to, if I'm going to look at a pot and a bridging strategy, a more conservative core strategy inside of my portfolio. If, however, I'm going to take risk tolerance and volatility into account at all in investing my money, and by the way, most retirees do, then suddenly, if I'm going to limit how aggressive my long-term bucket strategy is going to be, buckets tend to fall short every single time.
Wow.
And I think the other thing to take into consideration here is that regardless if you're going pots or bridges, you're leaving your first amount of capital actually in cash doesn't make a massive material difference to actually the long-term numbers as far as that's concerned. So if you feel better leaving some of your money in cash, it's okay. You probably can leave some of it, not too much obviously. You can certainly leave some of it in cash. Maybe just anecdote about this pots, bridges, and buckets. Let me not be accused of plagiarism here. Something that Henry came up with, and it's a theme that he's been running for quite a while.
I thought you created it.
Well, you gave me the credit, so now I've got to give the credit to somebody else.
Okay, last comments, gentlemen. Roland,
I think get a raise and start saving now.
you're talking to me
Yes.
specifically. Great, that's fantastic. I hope CBC heard this.
Eleni, for 60, you're looking good, I must say.
Thank you so much. Okay, but ultimately, how much would I actually need to retire?
Well, it depends how much income you want. That's all different.
We'll
You
discuss
see, and
this
that's the
offline.
interesting thing about retirement. It's all different for different people, depending on what it is that you're trying to achieve.
If you want your money to last as long as possible, try and invest most of it as aggressively as you're comfortable with. Understand what that means.
Especially when you're younger.
Especially when you're younger, and the same rule applies when you retire, point number 1. So that means whether I use a pot, a bridge, or a bucket, my core assets should be invested equally aggressively. That means, in short, a bucket and a pot and a bridge is going to give me more growth geared assets over time. A bridge is going to help me bridge that in the short term, and in the long term, I should be in the better position. So, personal opinion, bridging is probably the way to go.
Give me something more meaty, Roland. Come on.
Live like a rock star, die early, and use your money up front.
This is coming from a quant. My guests have lost their minds. Gentlemen, thank you so very much for joining us. It was great to debate my retirement. It was fantastic. Thank you so very much.